Welcome back. We will be looking at residual income. That is the second metric, second performance measure, second KPI that is to be discussed in the context of divisional performance measurement and management. Now, why we are looking at residual income is necessarily because it helps us address some of the weaknesses of ROI, which is the first one we looked at, that we proved, or that you would have seen how uh, dysfunctional decisions or suboptimal decisions are being made by divisional managers because they are doing things what's best for them at the expense of what's best for the company. There's no problem in people or managers doing what's best for them. Of course they should do, but it shouldn't be at the expense of the overall view of the company. This is the general consensus among businesses. So in order to address some of those issues, there is a good ratio called residual income, and what it does is it calculates not a percentage. So what we do with ROI to make the decision is we compare ROI. Let's say ROI is 10% and our cost of capital is 5% or 6%. ROI 10%, cost of capital is 6%. So if our ROI is 10%, we see that we are making 4% extra over the cost of capital. Right? Because cost of capital is what we need to keep servicing. It's the requirement to maintain our division, keep the division going, in terms of the capital that we keep funding the division with. So it's necessarily we are just seeing, are we making enough money to service that cost of capital? This is what we look at. Now, because of all those basis of the operating profit that gets used, etc., that we looked at through the examples, the ROI is a highly manipulative figure. Therefore, what we do is we move from that percentage version. We are going to try to look at it from pure dollar terms. What we do is we take the controllable operating profit of the division. If you are a divisional manager, investment center, we take the controllable operating profit, right? Operating profit. So revenue minus the operational costs. You take the operational profit of your division. That is why we call it controllable, relevant to you. And from this, we deduct your notional cost of capital. We call it imputed interest, notional interest, assumed interest, everything. Anything, any word can be used. But essentially, what we are doing is we take the controllable capital employed, that is the capital employed relevant to you, and multiply it by the cost of capital. So I'll give you a simple example. Let's say your division is making 100,000 controllable operating profit. You are responsible for $100,000 of controllable operating profit. Great. Now your entire division is serviced by debt of 1 million. It's a $1 million loan from a bank. And for this $1 million, we pay, let's say, 10% interest, right? That's your cost of capital then, 10% interest. So 10% into $1 million, that'll be too much, right? 1%. Okay, let's say 1%, $10,000. So your cost of capital every month, because you funded your division by $1 million loan, maybe it came from corporate, central finance, treasury, whatever. So you had to pay $10,000 every month, every year, annually, for that. Now your annual profit or annual controllable operating profit is 100,000. Your interest cost is $10,000. So your residual income becomes 100,000, which is the controllable operating profit, minus 10,000, which is the imputed interest. Now, of course, if your division is made up of equity also, then you would use the weighted average cost of capital to calculate that. If your business is only made of equity, you will be using the cost of equity. That doesn't matter. That depends on your business's corporate structure, the financing structure of your division. So you calculate that difference and you call it the residual income, the income that is residually left after you service the cost of your capital of financing the division. So it's a fairly more straightforward figure. There is some of the issues because you're having the dollar value. So some of the issues that you see with the kind of the issues that you see with percentage related comparisons that make it incomparable are eliminated. The other thing is you're not using the capital employed figure by and in and of itself. You're taking the cost of capital. You're looking at your, let's say if it's a loan, you're looking at your interest expense. to deduct to see how much money is left. So by doing that, you're actually eliminating those issues like, age of assets with ROI, because there's no basis to look at depreciation and to let age of assets impact, to use net book value to directly impact the figures. Indirectly, yes, of course, but you don't have those kind of issues. Because of that, those weaknesses are eliminated with residual income, and you have a pure dollar figure. $90,000. Can I do? Can I continue the business with this or not? Can I address this? Can I sort this out? You make a simple decision, a more clearer decision. So the decision rule is what? Like NPV. You can accept or you can say that the division is performing well if the RI is positive. If the RI is negative, it means you're not making enough money to service your notional or assumed or considered notional imputed interest, right? Then this division is not a worthwhile division or profitable division. That is how you um, deal with, or that is how you look at residual income. So in terms of what's good and what's bad, it reduces those problems of ROI. Now what you can do is there is proof. There are a couple of examples, TYU3 and TYU4, for you to try this out and see exactly how this issue is addressed. You can refer to the calculation video to see the discussion if you need further explanations. So let's take a look at what's good and what's bad about RI and ROI. Advantages: it reduces those problems. As I said, it's very easy to decide because positive accept, or good, negative bad. It makes divisional managers directly aware and they have to worry and they have to be concerned about the cost of capital, because how do they try to maximize the RI if we are rewarding them based on the RI? One thing they can do is they can try to increase the operating profit, controllable operating profit. That's revenue, improving revenue and managing cost better. The other aspect is they can try to manage their notional interest. They can try to bring down the cost of capital. If they bring down the cost of capital also, the RI will be higher, will be better. So the divisional managers, something that they didn't worry about earlier, they are now worried about, and that is definitely good. Different cost of capitals can be applied to divisions with different risk profiles. So you can actually, you have the freedom to break the divisional RIs into different components, depending on, maybe you have 5 products which have different risk portfolios, which are financed with different components of finance. And therefore you can do separate RI calculations and add those values and see what is the total. So this kind of flexibility is also provided. However, it does have certain disadvantages. See, the controllable operating profit. And when you calculate the notional cost of capital, you use the controllable capital employed. Both of these figures are coming from the income statement and balance sheets, and those can be manipulated. Absolute figure, so you cannot really pitch other divisions against each other because dollar values not directly comparable. Converting, that is something that beneficially, mathematically, we had as a benefit with ROI, because you had a percentage, so you can compare division A ROI, division B ROI. But a direct comparison is generally considered better because you know exactly how much money you're making. Difficult to determine the appropriate cost of capital, as always, especially if it's not straightforward. I took the example of a division being, fully funded by loans alone, but imagine there's a division or SBU that has both debt and equity, and time value is changing. Maybe the loan has variable interest rates, so that keeps changing. Equity risk profiles are changing. Maybe the environment is very volatile. So when you take all of this, the systemic, unsystemic risk components that you learn in F9, so all of these have an impact on the cost of capital, and therefore you know that calculating an appropriate, relevant weighted average cost of capital can be a challenging task. Different accounting policies can confuse the comparison because, as I said, accounting policies do impact the controllable operating profit and controllable operating, um, like for example, your depreciation basis. What basis are you using to calculate your depreciation? What is the lifetime of the asset you're considering? All of these will have a significant impact, or direct impact, indirect impact sometimes, on these figures that you're using to calculate RI, and thereby affecting your numbers. There may be liabilities, or there may be non-financial expenses that are included. as operating expenses when you're calculating operating profit, which might not actually materialize in any case. There may be credit receivables that are being used as revenue when you calculate operating profit that increases the operating profit. It's money that you haven't get. Maybe it's bad debt. Maybe you know you're not going to get bad debt, but you can consider when you're calculating the RI, you can consider those numbers and add some manipulation. So accounting policies will have an impact, and it may encourage manipulation of profit or capital employed figures, and thereby affect how this is calculated. So as you can see, RI is good. It does get the job done. However, still, it does address some of the weaknesses of ROI. However, still, as I said, non cash expenses, bad debt, depreciation policies, right? These kind of behaviors, all of these have a impact, or can have an impact, and can, it's better than ROI, but it's not perfect. So, we leave with that, and I'll see you soon. Good luck and thank you. You can definitely review the calculations video. Have a good day.